We got non-farm payroll data last week, solid number. Big jump higher, revisions higher. We also saw the unemployment rate moving up a little bit. The fact is, it's not really moving up so much as the civilian employment sector. The total number of individuals available to work is increasing, but the number of people being employed is pretty flatline. I've got some charts to show you on that and how that will affect the stock market as well. This week, big number coming up. CPI data, CPI and PCE, inflation deflator, which is the preferred number for the Federal Reserve, they mirror each other pretty heavily, but they are not exactly the same. Regardless, we get the CPI data point about 2 weeks before we get the PCE deflator. That's the one, PCE is the one that the Federal Reserve keeps their eye on. Expectations are we're going to see a little bit of a bump higher in PCE data. So how does this affect the stock market? In order to get inflation, you need an economy that is expanding continually. We just saw the data on jobs. We're seeing that continual increase, but it's the money supply that when you keep an eye on the year-over-year growth rate of money, how much the money supply is growing every single year, the rate at which it's growing, this breaks down what happens to the economy. Inflation, employment, the stock market, they're all lagging indicators to the economy. This is the data point you want to watch. The money supply, M2 money supply, its rate of growth. You see a strong correlation between inflation data points and, of course, the overall economy. Let's jump in. I'll show you the charts and show you why I think the stock market continues to move higher. All else equal, we do have January 21st rolling around the corner. Let's jump in. Here we're starting off with last Friday's non-farm payrolls. The monthly change, you can see a big pop higher, kind of a one-off if you ask me. Also September's number, that was October's number for non-farm payrolls. September's number did get revised higher. Again, a one-off simply because there were effects because of the hurricanes that hit the East Coast. So outside of that, we're basically seeing some slightly lower numbers, but we also see these numbers popping up here and there that are a little bit higher, hitting the 200 number with new non-farm payrolls additions. This is the civilian labor force versus the employed civilian sector. Civilian labor force, those individuals that the Labor Department thinks wants a job, has a job, is part of the civilian labor force. Your stay-at-home girlfriends, not part of the civilian labor force because they don't want a job. There are deadlines after a certain period. The civilian labor force, they look at you and say, you don't have a job yet? You must not want one. Starbucks is right down the road, even though you have like a PhD in macrophysics or whatever. Employed civilian sector, as you can see, hasn't really changed much. So although we're getting more and more individuals within the civilian labor force who want a job or are employed, the number of those individuals is not really, of those individuals being employed is not really changing. And that's really what the factor is. So when we see the unemployment rate, which here's the unemployed civilian labor force, the number of that, it's a subtraction, total civilian less employed gives you this, the unemployed civilian labor force, which gives you the unemployment rate. So we are seeing this moving up a little bit higher. It was like 4.267%. Not a big deal. Less than 5% used to be prior to the 2000, when the economy was just going gangster with the dot-com era. We used to consider 5% full employment. You really couldn't go beyond 5%. Well, we've seen sub 4% just recently. As this chart will show you. So these are some developments that, from an economist perspective, you look at this and you think we are at full employment. That once you get employment, transitional employment at such a low number, this is a sign that the economy is hot. There's plenty of jobs, and that usually means plenty of inflation. Core PCE versus the M2 money supply. Now, throughout these charts, I'm going to use the blue as the M2 money supply. Money, it's the fuel for the economy. You've got to watch the money supply, the rate of growth of the money supply. That's the key thing. Year over year change. It was here last year. Now it's here this year. We're seeing an expansion or contraction. I inverted the core PCE inflation number, and you can see how strongly it's correlated. If the money supply is expanding, inflation is growing as well. It's because the economy is moving forward. Should there be a reversal, you'll see that play out. Now we're seeing the money supply continually moving higher and higher. I'm still waiting on November's number, but if recent activity is any indication, we should be hitting a median number of roughly 3.25%. That should be the target median for the money supply, which would mean inflation is likely to go higher. So Wednesday's number could be a hot little ticket. We could see a pop higher in inflation. The stock market will not like that at all. The stock market could sell off. The bottom line is simply this: the Federal Reserve, and I've said this I don't know how many times. I said this all through summer. I said this all through last spring. The economy is too strong for the Federal Reserve to lower interest rates. Period. They lowered interest rates. I really wonder on the timing. They did September and October, of course, just before the presidential election. It's almost as if they were egging on what was going on. I did not feel that inflation was where it needed to be. I felt it was on its way down, but that the economy itself, broadly speaking, was too strong for the Federal Reserve to be necessarily dropping interest rates. Now, they were at what they would consider a restrictive level. Take a look at where we are now. This rate of growth for the money supply, which we're a fractional banking system, means that banks are lending out. They get deposits on a fractional banking system. They're lending out that money, and it's expanding, as you can see, the money supply, the M2 money supply, at a rate that is a bit hot. All right, moving forward, I wanted to show you the S&P 500. This is the overall broad number. It's a good parameter as to, you could be looking at SPY stock, SPX, S&P 500. They're all about the same, just a different name for it. But here is the S&P 500 in green versus the money supply in blue. Generally speaking, our economy continues to expand. The money necessary for the economy continues to expand, and we see the results of that in the S&P 500. Because of that, they kind of go hand in hand, although I always find it really interesting that we've seen the money supply and the S&P 500 cross lines. I don't know what that means. I keep sort of sitting in a coffee shop staring off into space like, what's next? What's next? The money supply may remain on its trend line. January 20th, I think, is the swearing date, and I think someone's going to get to work on January 21st. And that's when things could get interesting. All else equal, as long as the money supply continues to expand, the S&P 500, because the economy is expanding, means companies will have continued revenue growth along with personal incomes. All else equals up until January 21st. Here's a look at the money supply versus the S&P 500. Again, same chart, year over year change. You can see how heavily correlated the two are. And as the money supply continues to inch higher, the S&P 500 will probably remain elevated. Now, I think the rate of growth of the S&P 500, because it is, and if you look, you can see that it's a bit above median, which generally means that we need to get back down to median in order to maintain a standardized average. So we'll still see growth in the S&P 500, but the growth rate is likely to lower. Still be positive, however. And in fact, I think it was Morgan Stanley came out and said, we believe that the S&P 500 is going to grow about 2.5 to 3% over the course of the next 8 years. Well, why would they say that? Because the average over the past, say, 50 years was at 8%, and we've exceeded that number. So while we will see the S&P 500 on average continue to expand and grow, it will do so at a slower pace. But then we've got the tariffs. the tariffs act as a tax on consumers. If you want to buy something and the government steps in and says, we're going to tax that because it came from China, because it came from Canada, Mexico, whatever, the companies don't swallow that. They pass it on to you and say, okay, yeah, based on us shipping it into country, the shipping costs, the manufacturing costs, our small amount of profit, then the cut to the U.S. government, this is your new cost. Do you want to buy it or not? That's how that works. The fact that the president-elect sat there on, what was just yesterday, saying, I don't believe that consumers pay this. Wow. All right, good luck. Regardless, America's going to be great again because we're going to pay higher prices for all products in an attempt to bring back manufacturing for t-shirts here in the United States. Okay, so what do I really think is going to happen? He looks dead set that he wants to put tariffs on. Will they be a long-term effect? All companies are going to do is raise their prices. All consumers are going to do is probably bite the bullet and pay the price. At the same time, we're getting those tax cuts to corporations, which represents about 9% of tax take from the federal government. Those are going to continue, but they've created a big deficit, a big hole. So Trump's coming around saying, listen, because of that hole, we got to make up this money. Let's do this. At the same time, I'll negotiate a better deal. Well, Canada and Mexico, wasn't there a better deal just negotiated about 6 years ago by the current president-elect? What was wrong with that deal? He'll get some kind of stipulation or some kind of clause that declare a massive victory, we move forward. In the meantime, consumers are going to have to foot the bill on the corporate tax deduction, that the new tax, the rollover for the taxes that the tax Trump tax cut. My apologies. That's pretty much all that's going to happen. He's found a way to foot the bill for his taxes. Fine. Americans have to pay that tax. I didn't vote for that. Just saying. Given that, the Federal Reserve probably doesn't have to do anything, because when you step in and tax, you just effectively remove money out of the system. In fact, the Federal Reserve may be forced to lower interest rates because of that one factor alone. Whereas the Trump tax cut for corporations would be inflationary because of the deficit, now all of a sudden he's found a way to pay for it. And because of that, this removes money out of the money supply. And from there, we will see that the deficit reduces somewhat. So the Federal Reserve may have some wiggle room to go ahead and lower interest rates in the future. This takes months for it to play out. 3, 4, 6 months. Start looking for these moves midsummer by the Federal Reserve. Until then, the Federal Reserve has no reason to really make any kind of moves. So the stock market itself, given where we are right now, the S&P 500, SPX, SPY stock, whatever you want to call it, should continue forward, probably at a lower pace than previous. But the eventuality is we will see the Federal Reserve being forced to lower interest rates to goose the economy further. What the Federal Reserve would be doing is, while the U.S. consumer is paying taxes on all their consumption, they're simultaneously paying taxes on higher interest rates. The Federal Reserve can alleviate that, lowering interest rates, allowing more income to spend on the tax for or tariffs. So I don't see a catastrophic event occurring within the U.S. economy. But I do see a moderation in the pace at which the S&P 500 moves. We could see a correction. We're long overdue. But the eventuality is that this economy is so strong that it will probably swallow this and move forward, with the S&P 500 moving higher, but just at a smaller pace. Big kind of deal there. I'll keep this all posted. We've got the CPI data coming in on Wednesday, 2 more days, and that should get the stock market sort of raising an eyebrow. But the Federal Reserve has some work to do, considering what will likely happen probably January 21st. Make sure to hit that like and follow button. Make sure to hit my Substack newsletter so you can get the written content on this. See you in the next video.